What's up, folks? It's Eric from Option Edge, and in this video we're going to talk about all about covered calls. And if you stay till the end, we're going to talk about what stock I think is one of the best stocks to run the covered call strategy on. Let's get into it. What's up, everyone? It's Eric from Option Edge, and in this video we're going to talk all about covered calls. Let's go. So what is a covered call? Well, simply put, a covered call consists of two components. The first component is the 100 shares of stock that you're going to buy. So you need to own 100 shares of stock, and then you're short a call, preferably an out-of-the-money call, but you'll see that it doesn't necessarily have to be an out-of-the-money call. But yeah, that's it. It's just two components: stock, 100 shares, and a short call. And I'm going to go over why, in particular, it is 100 shares of stock. All right, real quick, let's visualize what it looks like to own 100 shares of stock. So here's a nice visualization. Let's say we buy 100 shares of stock when the stock is priced at $24.69. So basically, this is showing profit when the stock rises. The numbers on the x-axis are the stock price. Okay, so as the stock goes up in value, you're going to profit, and then the y-axis is going to be your profit. Okay, so now let's look at what shorting a call looks like by itself. So this is what selling a call looks like without any shares of stock. It is a short position. You profit as long as the stock goes down. In this case, you're shorting a 28 call. That's the strike price. And yet you're going to make money as long as the stock goes down or it doesn't move at all. You can even actually make money if the stock moves up a little bit. You're receiving a credit for 49 cents. So your break-even price would be just the strike plus the credit received, which is $28.49. All right, let's put it all together to get a visualization of what a covered call looks like. So it is a bullish position. Remember that. So we're taking our 100 shares that we bought at $24.69, and then at the same time, we're going to sell a call against those 100 shares. And in this case, we're selling the $28 call. And you'll notice that before, when we own stock, the profit and loss diagram, the green section, the profit section, continues to go up as the price of the stock moves along the x-axis. But you'll notice here is that doesn't happen. It flattens off. That's because we are selling a call right at the 28 mark, and you'll notice it flattens off right when the stock price hits $28. So keep this visualization in mind. It's going to help us for the remainder of the video. A helpful concept to know about options is that one option contract actually controls 100 shares of the same underlying stock, and it's going to use, when it comes to covered calls, you're going to use those 100 shares as collateral. So, for example, one Apple call contract controls 100 shares of Apple stock. If you just sell a call outright by itself, it's naked. Only by buying 100 shares of stock can you make the naked call no longer naked, and it becomes a covered call. You could also buy a call option, and that would create a call spread, but that's something different. But this is how we turn a naked call into a covered call by using the 100 shares. And the 100 shares will be used as collateral. Let's move on to the next slide. Just to explain how this whole collateral thing works. Let's say we sell a call at a given strike, $28, just like in the first example we showed you. So basically, by selling the $28 call, you're taking on the obligation to sell 100 shares of that stock at that particular strike price if the stock goes beyond your short call, which in this case is $28. So you have the obligation to the call buyer to sell him or her the 100 shares of stock at the predetermined strike price, okay? All right, let's talk about how we calculate our break-even point. So to do that, we're just going to take the stock price that we purchased the 100 shares at. So in this case, it's going to be the $24.69, 100 shares at that price, and then we're just going to subtract the credit we received by selling that call option. So we're selling a call option for 49 cents. So all you got to do is 24.69 minus the call credit, which is 49 cents, and 24.20 will be the break even, meaning we're going to make money as long as the stock price stays above 24.20. If the stock price stays at 24.20, then we would make zero money. All right, so here we're going to calculate the upside break-even point, and what I mean by upside break-even point is basically if we buy 100 shares of stock and then we sell the call, our gains are going to be capped at a certain threshold or at a certain stock price. So we're trying to calculate at what point will the stock reach where our gains from the call are no longer beneficial to us, and we would have been better off just owning 100 shares outright. So to do that, we just take the credit that we sold the call for, plus the 100 shares, the share price, $24.69, plus the credit, and we add those together, and then we get our upside break-even point. Anything over $25.18 is going to mean that we would have been better off just buying the shares outright, the 100 shares, and not selling the call along with the purchase of the shares. I hope that makes sense. All right, so imagine that this is a chart of a stock. We have our y-axis shows the dollars per share, and then this is going to be time, and this is going to be the expiration date where we sell our short call. So let's first start with a line. That's going to be our call that we're selling. So we're shorting a call at $10, okay, and we're going to buy 100 shares of stock at, let's call this $5 here in between the 4 and the 6. So as time goes on, this stock starts to appreciate in value. We're at around $7. Now we're at $8, and we're right next to our expiration dates. The question is, will we need to sell our 100 shares? Okay, so the stock rallies to about $12 on the expiration date. In this situation, we are obligated to sell 100 shares of stock for $10, okay? So our stock that we bought, the 100 shares, now remember, every option contract controls 100 shares of stock. So that means that when we're obligated to sell a $10 call, that means we're obligated to sell 100 shares of stock at this strike price. Okay, so what would happen would be the stock goes to $12. We sell 100 shares at $10. So at that point, you would sell your shares. You don't have shares anymore. For $10 a share, you sold them. But on top of that, you do keep the credit you received when you sold the short call. Let's calculate how much money we made in this scenario with this covered call that we sold above our shares. So remember, we bought the shares at $5 a piece, 100 of them, okay? And then we sold a $10 strike a call, and let's just say hypothetically we received a $1 credit. So the stock went up to $12. Our shares were called away at $10 a share because of the short call strike. Now what our profit ends up being is we have the appreciation of the stock. So we bought it at $5. We were forced to sell at the $10 strike, but you have to add the credit received from selling the call. Okay, so our profit is going to be 10 minus 5 is 5, plus 1 is 6, and or 600. 6 times 100 is $600 is our profit. And then if you want to just calculate how much we would have made had we not sold the call, the current stock price, $12 minus what we bought the stock for, which is $5. So we would have made $700 had we not sold the call. So not every time are we making out better than just buying stock by doing covered calls, but that's sort of the risk you take. You cap your gains. As you can see here, we end up capping our gains by 100. Okay, so we explained the mechanisms of how a covered call works, how you can make money, how you can get your shares called away, etc. But I just wanted to go over how exactly you profit with the covered call strategy. So there's 4 different ways that you can profit. Number 1 is the stock doesn't move at all. If the stock doesn't move, you will make money on the credit received from the call. Number 2, the stock moves up but still is below the short call. This is the most optimal way to make money because basically you're making money on your 100 shares and you're also making money with that credit received. So then the third way, the stock moves down but it doesn't move down too far. Your stock loses a little bit money, but the credit of the call is going to be larger than the move of the stock. So you end up making money with the credit still, even though you lose a little bit of money with the stock. And then number 4, the stock moves up beyond the short call. So if this happens, you receive your credit from the call you sold, but the stock is going to be called away, but you still make money
on this trade. So that's how you can make money, and then this is how you can lose money. So if the stock moves down too much beyond the credit received, then you will lose money. And here's just a quick back of the envelope type calculation. Yes, you have 100 shares at $8 a share. You sell a $9 call for 50 cents. Your break even would be $7.50. So if the stock goes below that $7.50, you would then start to lose money. Another reason why covered calls in many ways can be better than just outright owning shares of stock, and there's a few different ones. Let's start with number one here. You get to create some cash flow on a non-cash flowing asset. So that's number one. You reduce your directional exposure. So that means if you own 100 shares of stock, that basically your delta would be 100. If you were to sell a 30 delta call, your directional exposure would then be effectively 70. So that reduces your directional exposure. It reduces your cost basis. When you own 100 shares, you can sell a call and receive a credit, and that's going to reduce your overall cost basis. It reduces portfolio volatility, and this sort of goes hand in hand with reducing your directional exposure. By reducing your directional exposure, the volatility of your portfolio is going to be decreased. It can enhance returns. At the end of the day, this is the most important factor, and in many ways, it will enhance returns while also reducing portfolio volatility. So that's like a double win there, win-win. And then you can take advantage of high volatility call premiums. So when volatility in certain underlying stocks is high, you can sell a call and make more money than usual. So what are some of the negatives of covered calls? So you cap your stock gains at a max profit. So you're selling $11 call on a $10 stock, and the $10 stock goes to 15. Well, you missed out on some gains there. Your shares will get called away if the stock moves beyond that short strike or above that short strike. And what can happen here is if the stock keeps going up and your shares get called away, you're going to miss out on some appreciation. You're going to miss out on gains. So that's sort of the negative side of covered calls. But at the end of the day, you can't lose money if the stock goes up. Next, I want to talk about selecting the correct strike. So there is really no correct strike, but I like to do out-of-the-money calls. I think they work best. And if with out-of-the-money calls, give yourself two chances to win. The stock can appreciate and you can make money on the stock while also making money on the call received before your shares get called away. You might think selling out-of-the-money calls, super out-of-the-money calls, further out of the money might be the best, but you're going to receive less premium. There's really no free lunch, so to speak. And a lot of people like to sell calls at the 16 delta, which is about one standard deviation move. So is there an edge in covered calls? So for many stocks, there is an edge. You will actually enhance your returns by selling covered calls. And one of the main reasons is when implied volatility is high, it tends to be overstated. So by selling high implied volatility call options, you can capitalize on that overstatement in implied volatility. Next, I want to talk about rolling, and I have made videos about how to roll on Robinhood and rolling in general. So if you'd like, I'll link to that somewhere here. So if your stock starts to come close to breaching your short call strike, what you can do is roll your call strike out and up. So this means you're going to move your expiration date further out into the future to hopefully collect more credit. And then you're going to roll up your strike so that your 100 shares don't get called away. Look at my video that I'll link to.
All right, one of the stocks that I personally think is a great candidate for a covered call strategy is Applied Materials. And the reason why I like this stock is because fundamentally it is very good. It's got some good thematics behind it. Basically, I won't go too far into what the stock is, but it's used in semiconductor manufacturing, and it's sort of the pickaxe to all the semiconductor manufacturing boom that we're seeing. So if you think technology is going to increase and you think that we're going to need more computers, and you think computers are going to get better and better, then I think this is a good pick. It's not financial advice at all, just my opinion. So what's great about this company is, one, it's $114. It's a little bit pricey. You need almost $12,000 to run a covered call strategy. For some, that's not too bad. For others, that might be a little pricey. All right, so I'm in the options chain for AMAT. So the other thing that's great about this, let's just look at a random, let's just go to April 21st. What's great about this is it has weekly options. So the reason why that is good is if you need to roll out and up in time, You have a lot of different expiration dates to choose from, and once you start doing this, you'll realize how much easier it is to roll when you have weekly expirations versus monthly. Monthly doesn't give you, very good. It just makes it more difficult to roll. The other thing is the strike prices are $1 wide. Closer the strike prices are, the easier it is to roll up. You can see that the monthly options use 5 wide strike prices, so this makes it harder to roll. The weeklies are all $1 wide. So let's just say we want to sell a call. Let's say we want to sell the 120 call. Let's take a look at the volatility in this name. So the implied volatility is about 38% right now. That's not crazy high. Like Tesla is probably about like 80 or something. But nonetheless, you're getting, this is probably about double the S&P 500 vol currently. You're getting some juicy premium, and premium tends to be overstated. So I'm not, don't quote me on this, but the juicier the premium, usually the more opportunity you have at selling volatility. So that's just something I think. Yeah, and then thirdly, the other thing that's great about this is it has a dividend. So not many technology stocks have dividends. A lot of these higher growth companies do not give out a dividend, but you're getting a decent 1.12% dividend. I'm not a dividend guy, so compared to names like, for example, AT&T, which has been like a dividend investor's favorite stock for some time. However, the stock's been depreciating over time. So like you're getting a fat dividend, but the stock's going lower and lower and lower. So that's something you don't want. On the other hand, this stock is over time. This is the 5-year chart. You can see back in 2019, this was a $38 stock. So this thing has like tripled in value since then. And hopefully, we've been in this little bear market, so we've had a little bit of a dip, and we've been moving higher off that dip. So this stock, I think, is going to appreciate in the future, and you got that dividend. So you can it's sort of like a triple threat. You have the appreciation of the stock, the dividend payout, which you can then reinvest, and then you can sell covered calls on top of it and make income while you're waiting for this thing to go up and up and up. And then on top of the bonuses, the options chain has dollar wide strikes and weekly options. So I think this is a really good candidate for running the covered calls strategy in. So that's about it for covered calls, guys. I went into a lot of different areas. I hope that explained it well. If you have any questions, please ask me. I sort of jumped around, but hope this helps. Peace out.